My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com.
What if you can own the entire AI and semiconductor chip boom, every major semiconductor stock, with up to $20,000 of upside in one trade, and you get paid to put this trade on? This is not a prediction. This is a real position that I just opened, and I'll show you the entire fill straight from my brokerage. The ETF that holds every major semiconductor and AI chip company in one ticker. The structure is my finance bull. I get paid to enter. I keep a massive long-term upside, and I win whether chips rip higher or they pull back. I'll prove every number with a real screenshot. This is the exact kind of trade that I send my members in real time, and you'll understand it completely, even if you've never traded an option before. No predictions, no price targets, because I don't believe that anybody can reliably predict where the chip stocks are going to go next. But what I can do is I can use a structure to open a trade that pays me to enter while also provides $20,000 of upside, also dramatically reducing my risk. This trade wins in 3 different directions as well. Not just the one direction if I buy the shares outright, because my whole job is to teach you to win when you're right, win when you're wrong, and never gamble. And stay till the very end. I'll show you the fully defined risk version. Even if you've never traded an option in your entire life, you'll understand exactly how this trade works. Here's exactly what you're getting. The real trade, the real fill. You'll see the exact credit that I received, how I get paid to enter, and I win whether the underlying ETF goes up or down. And remember, at the very end, I'll show you the defined risk version with the exact strike prices that I would trade in order to turn this trade into defined risk. First, why the entire AI chip sector? SMH is one of the backbones of the AI build-out. It includes the chips and the infrastructure, a huge chunk of what AI runs on. And while it's already run a long way, the question everyone has is, chase it here or wait? My answer isn't a prediction, it's a structure. Why I'm not just buying the shares. If I just buy shares, I only win if it goes up, and I'm paying full price today. Instead, I want to participate in the upside and get paid to wait, while also having a plan if the ETF drops. That's exactly what this option structure does. Never traded options before? Here's the whole idea in 20 seconds. Selling a put just means I agree to buy the entire AI chip sector at a lower price, and I get paid cash today for agreeing. It's exactly like placing a buy it on sale order below today's price, except you also get paid to place that trade. If SMH or another ETF or a stock never drop to my price, then I keep the cash. If it does drop, I own one of the best companies in the world or one of the best ETFs in the world at a major discount. That's the edge. Get paid to be patient instead of paying full price and just hoping that it goes up. The setup, my finance bull trade on the entire AI chip sector. The bet, I bought a $700 call. I sold a $900 call. This provides me with $20,000 of upside for every one lot. This is a call debit spread, and it provides upside participation. Then I finance this by selling the 490 put, only because I would love to own SMH at 490, which is a steep discount to what it's currently trading at. The result, I opened this trade for a credit. I got paid $200 just to put this trade on. Most people pay when they buy call options, but I got paid to place mine. It's like walking into a casino and the casino pays you to sit down at the table. If AI and semis go up, my 700 by 900 call spread profits up to $20,000, and I keep that opening credit no matter what happens. And here's the actual trade. You can see that I was paid $200 to enter. I opened this trade on June 18th. I sold the 490 put, and I used that premium to pay for the call debit spread that provides me with $20,000 of upside potential. And remember, I keep that $200 of credit no matter what happens. Remember, Stay till the very end and I'll show you how to run this with defined risk, plus the exact strike prices that I would use if I were turning this into a defined risk trade. But first, let me show you why this trade wins in more than one direction. Before we do that, let me be precise. This is not a defined risk trade. The put is naked, which is undefined risk. I want you to know that. But I sell that 490 put on purpose because that's the price where I would love to own SMH at. Remember, people have purchased SMH at around $650. So for me to own it at 490 would be an enormous discount. Are you nervous about selling a naked put option? Then no problem. Stay until the end and I'll show you the fully defined risk version. One really smart and interesting part of this trade is that I keep the risk short, but the upside long. If you notice, the naked put has a shorter duration than the long call. The naked put expires on December 2027 because I never want long dated naked puts sitting open. But the call spread is long dated. That expires December 2028. So I hold the full $20,000 of upside as long as possible. Short the risk, long the reward. However, one important additional comment about this, that 490 put option that expires in December 2027, I'm going to roll that in. So that way it expires around December 2026. I'll do that over the next few months. And eventually, we'll be left with no risk on this trade because that 490 put is going to expire and I'll only be left with upside potential. And that's the name of the game. You want to minimize your risk as much as possible while maximizing your profit potential. Quick, don't go anywhere. The defined risk version I promised you is about 90 seconds away. The exact trade with strictly limited risk. But first, the one mistake that ruins this trade for most beginners, and it's not what you think. How this trade wins up, down, or sideways. Up. If SMH goes up, the 700 by 900 call spread profits, and I keep the credit, up to $20,000 of profit. If it falls down to 490, I own the whole semiconductor sector at my strike price, a price I chose because I'd be happy to own it, and I also would keep the $200 credit that I received when putting this trade on. If SMH moves sideways, then I keep the $200 credit, and the short put and the long call debit spread will expire worthless. Remember, if you're long the stock, you can only win one direction if the stock price appreciates more than your purchase price. So when you trade options, it can reduce your risk and also dramatically improve your profit profile. But let's say you want to own the shares. And what happens if SMH keeps rising? If you want to actually own the entire AI chip sector, then if SMH falls to my strike price, then I'll take ownership at 490 and I will own it at a price that's substantially cheaper than it's trading at right now. And remember, I also keep the credit. But if you're worried that you're going to miss a big AI run, the call spread profits as the entire AI chip sector rises up to the cap. And remember, you are also paid to enter the position. The only thing that you give up are the gains above that cap. For a company or an ETF this good, acquiring the shares at a discount, plus getting paid when you put the trade on, and participating in the upside beats paying full price and hoping that the underlying stock or ETF will go up. Why getting paid to enter is the entire edge. Most traders pay money when they buy a call option, so they need to be right on the direction and the timing. But I opened this trade for a credit, so time passing and a flat market, they both work for me. I don't need to panic. I need structure. That's the entire difference. The number one mistake that ruins this trade. This only works if you genuinely want to own the stock at your put strike. Selling puts on a company you don't want to own equals gambling for premium. The discipline is the edge. Pick the company or the ETF first, the strike second. Is this too good to be true? The honest risk. Real talk. The risk is that the entire AI chip sector craters far below 490. Then I'm assigned SMH at 490 and I'm forced to own it above the market price. That's the real loss and it's not a bargain. That's why I only sell puts on companies I'd be happy to hold for years. Remember that no trade is risk-free. This one just pays me to take risk I already wanted. Here's the real account that these trades come from. You can see that we've dramatically outperformed the market. And then also during times like March 2026, when the market was down 7 or 8%, we were down less than 1%. By trading options, you can dramatically increase your profit potential while also reducing your risk. Here's the real lesson. I don't have to predict the entire AI chip sector. I structured a trade that wins more than one way, up, down, or sideways. I was simply paid to be there. Win when you're right, win when you're wrong, never gamble. All right, here's what I promised you about turning this into a defined risk trade. If selling naked puts makes you nervous, then instead of just selling the put, you can sell one put and you can buy a lower price put. Now your downside is capped. Yeah, you'll give up a little bit of premium, but you know your exact maximum risk. Second, I sold the 490 put because that's a price where I'd be thrilled to own the whole chip sector, a steep discount from where it's trading at today. If it falls there and I'm assigned, I'm not upset. I'm getting one of the best ETFs in the world on sale. Now, regarding the exact strike prices that I would select if I were turning this into a defined risk trade, when I sold it naked, I sold the 490. As a defined risk trade, I would sell the 530 and I would buy the 440. So that way I would have $90 per share of risk. By doing that, I would be able to collect even more premium. And then I would use that increase in premium to purchase the 440 put option. That way I would reduce my risk from $490 per share when selling a naked put option to only $90 per share by selling the 530 and also buying the 440. Also, remember, if you have a smaller account, you're going to have to trade vertical credit spreads. Selling a naked put with a 490 strike price is going to use up a lot of buying power. It'll use up about $10,000. Now you can use vertical credit spreads so that way each trade minimizes the amount of buying power that you would need. Who's telling you this? I'm a former Wall Street investment banker, Ivy League graduate, and every trade I show is real and verified. These are the exact trades I send my members in real time, and you can get them too. There's a 14-day trial. Link is in the description. Even if you've never traded options before, start there. Want to see my actual results? Watch this next. I show my actual trading statements. I'll try to put a card right now so that way you can click on it and go directly to that video. That's the trade. Pay to enter. A winner whether the entire chip sector goes up or down, and a structure you can run on almost any great company or ETF. If you want every trade I make in real time, the link is below. And tell me in the comments which stock or ETF I should do this on next. Your pick could be the next video. Win when you're right, win when you're wrong, never gamble. See you in the next one.
Visit beststockstrategy.com and submit your email address to receive invaluable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.